Ottawa says it just put $840 back in your pocket, a tax cut for 22 million Canadians. So why does your paycheck look exactly the same as last year? You heard the headline, right? The lowest tax rate dropped from 15% to 14, a real cut. So you checked your pay, looked for the raise, and found maybe a coffee's worth. Here's the thing. The cut is real, but the number on the government's poster and the number that actually lands in your account, two very different things, and almost nobody explains the gap. Because there are three catches buried in this tax cut. One of them quietly shrank a tax credit you've claimed your whole life, and the third one, most accountants barely mention it. So if your paycheck didn't budge this year, you're not imagining it, and you're definitely not alone. There's a reason, and once you see it, you can actually do something about it. Stick with me, because by the end, I'll show you three legal moves that turn this tiny cut into real compounding money. But first, let's look at what they actually promised you. Quick hello first. I'm Jay, and this is the Maple Finance, where we break down Canadian money in plain English. No jargon, no hype, just the stuff that actually changes what you keep. So here's exactly what you're getting in the next few minutes. First, the real number you'll actually pocket from this tax cut. And I'll warn you now, it's nowhere near 840. Second, why your paycheck looks frozen even with a lower tax rate. Third, the sneaky one, a tax credit you've claimed for years that quietly lost some of its value in 2026. And then the part you'll actually want to write down. Three completely legal moves that take this little cut and turn it into real compounding money that stays in your pocket. One quick thing before we get into it. I'm not your accountant, and this is not financial advice. Always do your own research. Cool? Cool. All right, let's start with the pitch. Because the pitch honestly sounds fantastic. A tax break for 22 million Canadians. Money back for working families. And every word of it is technically true. That's exactly what makes the catch so easy to miss. So let's start with what actually changed. For the first time in years, Ottawa lowered the bottom income tax rate from 15% down to 14 on roughly the first $58,000 you earn. And because almost everyone earns income in that first bracket, almost everyone qualifies. The government says about 22 million Canadians will pay a little less tax. That's most working people in the country. How much less? The headline numbers are real, up to $420 a year if you're single, and up to $840 for a two-income household, every single year. On top of that, the basic personal amount went up, the slice of income you pay zero federal tax on. For 2026, that's just over $16,400, completely tax-free off the top. Here's a detail that trips people up. The cut started July 1st, 2025, halfway through the year, so last year only counted as 14.5%. 2026 is the first full year at 14. And look, $840 is not nothing. That's a few weeks of groceries or a couple of hydro bills in a year where everything already costs more. On paper, it's a real win. And to be fair, this is all legit. It's on the CRA website, it's in your tax brackets. The money is technically there. If you stopped watching right now, you'd think you're getting a clean little raise. But you're not going to stop watching, because here's catch number one. That $840 headline, almost nobody actually gets it. Let me show you the real number. Go back and read the promise carefully. It's not $840, it's up to $840. And in tax language, up to is doing a lot of heavy lifting. To get the full amount, you need enough income to fill up that entire first tax bracket. Most people don't. So the maximum is exactly that, a maximum, not what lands in your account. So what do people actually get? On average, around $330 for most filers, and for those in the lowest bracket but people who need it most, closer to $90. Sit with that for a second. The Canadians stretching hardest to cover rent and groceries get the smallest cut. The headline was built around the best case, not the typical one. So already, that 840 in your head should probably be a few hundred tops. But here's the part that really stings. Even that smaller number doesn't fully show up in your paycheck.
Because while one hand was handing you a tax cut, the other hand was quietly reaching back into your paycheck. That's catch number two, and it's the one almost nobody sees coming. Okay, here's why your take-home pay barely moved. Income tax is only one thing coming off your check. Right next to it sit two more deductions that just went up, CPP and EI. Canada has been steadily beefing up the pension plan for years. Great for future you in retirement, but it means more comes off today. For 2026, CPP now bites on income up to $74,600. And if you earn a bit more, there's now a second slice of CPP on top, on income between that ceiling and about $85,000. More retirement security, sure, but more off every check right now. Then there's EI. The premium sits at $1.63 for every 100 you earn, up to about $69,000. Add it all up, and your deductions quietly grew the same year your tax rate shrank. So before you fire off an angry email to payroll, this isn't a mistake. It's just how the math collides. Your tax cut is real, but a chunk of it gets eaten before it ever reaches you. For a lot of middle earners, the lower tax rate and the higher contributions roughly cancel out, so your paycheck sits there frozen, stiffer than a January morning in Winnipeg. Not your imagination, just two forces pulling opposite ways. But okay, averages and deductions, that's kind of expected. The third catch is the one that actually surprised me, because this tax cut quietly made some of your tax credits worth less. Let me explain. Quick background, and stay with me because this is where it gets clever. A bunch of your tax breaks are non-refundable credits, things like the basic personal amount. They're all calculated using that lowest tax rate. Here's the catch. When the lowest rate dropped from 15% to 14%, the value of those credits dropped too. Same credits, slightly smaller benefit. Lower the rate, and you quietly shrink every one of them. Take the basic personal amount. Claim that 15%, the credit was worth more. At 14, that same amount is worth about $150 less. One quiet line and your biggest credit got smaller. And the government knew this would happen. Their own numbers show the rate cut quietly clawed back billions in credit value. So they bolted on a patch, a brand new credit just to cover the gap. It's called the top-up tax credit. In plain English, it keeps your credits valued at the old 15% on the part that matters, so nobody actually ends up paying more tax because of the cut. So why does this matter if it's patched? Two reasons. It's temporary, set to run only through 2030, and it's automatic only if you file correctly. Miss it, and you could quietly overpay. All right, three catches. The headline's a best case, your deductions ate the rest, and your credits quietly shrank. Depressing, I know. So let's flip it. Here's how you actually come out ahead. Here's the mindset shift. You can't change the tax cut, but you can decide where your money gets taxed, and that's where the real savings live. Three moves, simplest first. Move 1, the RRSP. When you contribute, you get the deduction at your top tax rate, not that 14% floor. So if you're in a higher bracket, every dollar you put in saves you 20 to 26 cents, sometimes more. Here's the combo. Take the few $100s the tax cut frees up and funnel it straight into your RRSP. Now you're stacking a deduction on top of the cut instead of letting it vanish into everyday spending. Move 2, if you don't own a home yet, in this brutal housing market, the first home savings account. Put in up to $8,000 a year, get a deduction, and pull it out tax-free for a home. It's the only account in Canada that gives you a deduction going in and tax-free coming out. So your tax cut dollars plus a refund plus tax-free growth toward a down payment. That's a stack most people completely miss. Move 3, for everybody, the TFSA. And before you say you've got nothing left to invest, that's the trap. Up to $7,000 a year, and every dollar of growth is tax-free for life. And this is how a boring $90 or $300 cut becomes real money. Invested and compounding tax-free, those small yearly amounts can snowball into thousands over a decade or two. Small seed, big tree. One quick filing tip so you don't trip up. Remember, 2025 was a blended 14.5% year. Use good tax software or a pro so your refund math is right and so you actually claim that top-up credit. Put those together and the picture flips. The cut alone is small, but the cut plus an RRSP, an FHSA, or a TFSA turns a token few $100s into a habit that actually builds wealth. Before you go, 3 mistakes that quietly waste this tax cut. I see people make all 3 every single year. Avoid these and you're already ahead of most Canadians. Mistake 1. Spending the difference. A few $100s spread across a year is basically invisible. It just disappears into gas and groceries. If you don't move it on purpose, the cut quietly evaporates. Mistake 2. Ignoring the deduction side. Those bigger CPP contributions aren't gone. They're buying you a richer pension later. Plan around that and top up your own accounts instead of just feeling poorer today. Mistake 3, and this one can actually cost you. Filing carelessly and missing the top of credit or messing up the blended rate year. A few minutes of care here protects every dollar we just talked about. So there it is. The headline said 840. The reality for most is a few hundred, sometimes closer to 90 after CPP, EI, and shrinking credits do their thing. But now you know how to make it count. Now, I want to hear from you. Drop your province and a rough income range in the comments, and I'll tell you which of these 3 moves would put the most back in your pocket this year. If this saved you even one of those mistakes, hit subscribe. It's how the Maple Finance keeps helping Canadians keep more of their money. I'll see you in the next one. Take care.